In 1602, 7 private companies in the Netherlands merged to form what would become the most valuable corporation in human history. When you combine Apple's $2.8 trillion market cap, Microsoft's $3.1 trillion, Amazon's $1.8 trillion, and Saudi Aramco's $2.1 trillion, you get $9.8 trillion. But even that massive figure falls short of the Dutch East India Company's inflation-adjusted peak valuation of $7.9 trillion in 1637. That's more wealth concentrated in a single corporation than most modern nations produce in an entire year. But this isn't just about money. This is about the blueprint that created modern capitalism itself. Right now, in 2025, every corporation trading on the New York Stock Exchange, every multinational company operating across borders, every private equity fund managing pension investments follows the exact same organizational playbook written 400 years ago by a quiet Dutch dynasty that most people have never heard of. The House of Orange didn't just build an empire, they built the system. And that system still controls your life today. What I'm about to show you isn't conspiracy theory or speculation. These are documented government records, shareholder reports, and financial statements held in the Dutch National Archives, the British Library, and the Library of Congress that prove the same pattern has been operating for 4 centuries. The Dutch East India Company wasn't just a trading company that happened to get lucky. It was the world's first corporation, creator of the first stock exchange, and architect of the first multinational monopoly. But more importantly, it was the first time in human history that private capital became more powerful than kings, and the institutional framework they created became the foundation for every major corporation that exists today. The family that orchestrated this transformation didn't disappear when the Dutch East India Company dissolved in 1799. They adapted, evolved, and embedded themselves so deeply into the global financial system that their influence became invisible. Today, descendants of VOC shareholders control major stakes in Royal Dutch Shell, Unilever, Philips, and dozens of other multinational corporations. Their fingerprints are on the Federal Reserve System, the Bank for International Settlements, and the World Economic Forum. The House of Orange still wears the crown. You just can't see it anymore. Let me take you back to 1580, when the world's largest empire was born not through conquest, but through marriage. Spain's King Philip II inherited the Portuguese throne, creating a personal union that gave one monarchy control over territories spanning 4 continents. Overnight, Spain controlled Portuguese trading posts in Goa, Macau, Nagasaki, and dozens of ports across Asia. They dominated silver mines in Peru and Mexico, sugar plantations in Brazil, and spice routes through Southeast Asia. For the Dutch provinces, still fighting their brutal war of independence against Spanish rule, this merger represented nothing less than an existential threat. The man who understood this threat most clearly wasn't a soldier or a diplomat. His name was William of Orange, known to history as William the Silent. Born in 1533 into one of Europe's most powerful noble families, William inherited vast estates in France, Germany, and the Netherlands. But by 1580, traditional aristocratic power was crumbling under the weight of Spanish imperial expansion. Land-based feudal wealth couldn't compete with colonial gold flowing into Spanish treasuries at unprecedented rates. William faced a choice that would reshape the world economy. He could either accept Spanish dominance and watch his family fade into irrelevance, or he could invent an entirely new form of power. Traditional military resistance had failed. The Spanish army was the most professional fighting force in Europe, funded by American silver and Portuguese spice profits. But William saw something that Philip II missed entirely. He realized that private investors, organized correctly and given proper incentives, could mobilize resources faster and more efficiently than any monarchy. The genius wasn't in recognizing the power of capital. Venetian and Genoese bankers had been financing kings for centuries. The genius was in understanding that capital could be organized to replace kings entirely. Between 1580 and 1602, William's son, Prince Maurice of Orange, worked with Amsterdam's merchant families to design something that had never existed before: a private corporation with sovereign powers. In 1602, after 20 years of careful planning, 7 competing Dutch trading companies merged to form the Verenigde Oostindische Compagnie, known today as the Dutch East India Company, or VOC. But calling it a trading company completely misses the revolutionary nature of what they created. The VOC was granted extraordinary powers by the Dutch States General. It could wage war against foreign nations, negotiate treaties with Asian rulers, establish colonies, mint its own currency, maintain armies and navies, and execute justice in territories under its control. For the first time in human history, a private corporation wielded the full power of a sovereign state. The VOC could declare war on Portugal's Asian empire without requiring approval from any Dutch government. VOC shareholders could profit from military conquest without paying taxes to fund those wars. The corporation could establish law and order in territories thousands of miles from Amsterdam without creating any financial obligations for Dutch taxpayers. This wasn't just a new form of business organization. This was a complete revolution in how power itself could be organized and deployed. The House of Orange had solved the fundamental problem that destroyed every previous attempt to challenge Spanish dominance: how to mobilize resources for long-term imperial competition without bankrupting the state or triggering taxpayer rebellions that typically ended dynastic rule. Here's where the pattern that still governs global capitalism today was first established. The VOC wasn't just trading spices and exotic goods from Asia. It was using systematic financial innovation to destroy monopolies that had existed for over a century. Portugal controlled the European spice trade through a network of military bases, government fleets, and exclusive trading agreements with Asian rulers. They had fortified ports in Goa, Macau, Malacca, and Nagasaki. Their Estado da India employed thousands of soldiers, administrators, and sailors. By 1600, Portuguese spice imports generated profits equivalent to roughly $2 billion annually in today's currency. The Dutch couldn't match Portuguese firepower ship for ship or fort for fort. Portugal had been perfecting their Asian operations for over a century, and they had the backing of Spanish imperial resources. So the House of Orange created something more powerful than military force: distributed ownership that could scale indefinitely. When the VOC issued shares in 1602, they opened imperial expansion to mass participation for the first time in human history. A baker in Amsterdam could buy into Indonesian nutmeg plantations for the equivalent of $50. A blacksmith could own a piece of Javanese coffee exports for $75. A shipbuilder could invest in Ceylon cinnamon operations for $100. This wasn't charity, patriotism, or speculation. This was calculated financial engineering designed to solve the fundamental resource mobilization problem that had limited every previous empire. The numbers tell the complete story. In 1602, the VOC's initial public offering raised 6.5 million guilders, equivalent to roughly $800 million in today's purchasing power. That was more capital than Portugal's entire Asian operation had accumulated over a century of colonial profits. But the VOC didn't stop there. They created the world's first secondary market, where shares could be traded daily based on news from Asia. They issued bonds secured by future spice imports. They developed maritime insurance contracts and commodity futures that allowed investors to hedge risks across different trade routes. By 1610, Amsterdam had the world's first modern stock exchange, complete with trading floors, standardized contracts, and published price information. By 1640, VOC shares were trading at 20 times their initial public offering price, creating the first major stock market boom in recorded history. Ordinary Dutch citizens had become personally invested in Asian imperial expansion in ways that Portuguese or Spanish subjects never were. The Portuguese fought back exactly as you would expect. They deployed larger fleets, built stronger fortifications, and negotiated exclusive agreements with more Asian rulers. But they were fighting yesterday's war with yesterday's financial instruments. Every time the Portuguese Navy destroyed a Dutch trading fleet, new VOC investors stepped forward to fund replacement ships. Every time Portuguese forces captured a Dutch trading post, the VOC simply offered better terms to local merchants and established new commercial relationships. Portugal was limited by government budgets approved by kings and constrained by taxpayer resistance. The VOC was limited only by investor confidence and market demand for Asian goods. When Portuguese military campaigns succeeded, the costs were borne entirely by the Portuguese crown. When VOC military campaigns succeeded, the profits were shared among thousands of Dutch shareholders who had personal financial incentives to support further expansion. Within 30 years, This financial architecture had completely reversed the balance of power in Asia. By 1630, the VOC controlled 60% of the European spice trade. By 1650, they controlled 85%. Portugal had been systematically outcompeted, not by superior military tactics or better navigation, but by superior financial organization that could mobilize resources more efficiently than any government-based system. The pattern was now established for all time. Private capital, organized through corporate structures and distributed ownership, could defeat state power in direct competition. This wasn't theory. This wasn't ideology. This was mathematical proof that had been tested under actual combat conditions and verified by double-entry bookkeeping. 60 years later, the English learned this lesson and applied it with even more devastating effect. The British East India Company, founded in 1600 as a direct response to Dutch success, used identical financial structures to dismantle the Mughal Empire and colonize the entire Indian subcontinent. By 1750, the British East India Company controlled territories generating tax revenues larger than the British government's entire domestic budget. The British East India Company's conquest of Bengal in 1757 generated annual profits of £12 million, equivalent to roughly $2 billion today. These profits weren't shared with the British government. They belonged entirely to company shareholders, who included members of parliament, aristocratic families, and middle-class investors across Britain. The company maintained private armies larger than most European national forces, but the costs were funded through Indian tax revenues rather than British government budgets. When news of Robert Clive's victory at the Battle of Plassey reached London, East India Company shares doubled in price within 6 months. Ordinary British investors had become personally enriched by Indian colonial exploitation without requiring any parliamentary approval or taxpayer funding. The Dutch model had been perfected and scaled to continental proportions. By 1800, British East India Company territories in Asia generated more wealth than the entire British domestic economy. The company ruled over 60 million people across India, Burma, and Malaysia while maintaining complete independence from British government oversight. When the company's private armies conquered new territories, the profits flowed directly to London shareholders rather than the British Treasury. This created the same dynamic that made the VOC impossible to defeat militarily. Every successful military campaign generated private profits that funded further expansion. Every conquered territory provided tax revenues that paid for larger armies. The system was self-reinforcing and self-financing in ways that government-funded imperialism never could be. The pattern is undeniable. Both the Dutch VOC and British East India Company achieved imperial dominance by organizing private capital through corporate structures that aligned individual investor incentives with territorial expansion. Traditional monarchies couldn't compete because they couldn't mobilize resources as efficiently as corporations with distributed ownership. 250 years after the VOC perfected corporate warfare in Asia, a 31-year-old man in Cleveland, Ohio, watched this exact pattern play out in the American oil industry. John D. Rockefeller had studied the Dutch model carefully through his education at Cleveland's Central High School, where students learned about Dutch commercial innovations as part of standard curriculum. In 1870, Rockefeller controlled exactly 4% of American oil refining capacity. By 1880, he controlled 90%. By 1904, Standard Oil held 91% of oil production, 85% of final sales, and 96% of pipeline transportation. Rockefeller didn't invent horizontal integration or vertical consolidation. The Dutch East India Company had perfected both strategies centuries earlier. Just like the VOC systematically acquired competing spice traders throughout Southeast Asia, Rockefeller systematically acquired competing refineries throughout Pennsylvania, Ohio, and West Virginia. Just like the VOC used financial leverage to destroy Portuguese trading monopolies, Rockefeller used railroad rebates and predatory pricing to eliminate rivals who couldn't match Standard Oil's scale economies. The financial mechanisms were identical, down to specific details. Just like the VOC created holding companies that owned shares in regional trading operations across different Asian territories, Standard Oil was technically a trust that owned shares in 40 different regional oil companies across different American states. Just like VOC shareholders received dividends from Indonesian spice operations without personally traveling to Asia, Standard Oil shareholders received profits from Texas oil wells without personally investing in drilling operations. The receipts are public record, and the numbers prove systematic application of the Dutch model. Between 1870 and 1900, Standard Oil's annual profits increased from $1.1 million to $57 million, a growth rate of 4,200% over 30 years. During the same period, consumer oil prices dropped from 58 cents per gallon to 7 cents per gallon, a decrease of 88% that eliminated most competitors while creating mass market demand. Competitors faced the same impossible choice that Portuguese traders had faced in the East Indies: sell to Standard Oil at below-market prices, or be destroyed by sustained below-cost competition that Standard Oil could finance indefinitely through access to capital markets. Between 1872 and 1879, Standard Oil acquired 223 competing oil companies. 91% of these acquisitions occurred after competitors had been weakened by predatory pricing campaigns that Standard Oil funded through bond issues and bank loans. Even the corporate legal structure was directly copied from Dutch precedents. Standard Oil's trust agreement, drafted in 1882, used language and organizational concepts derived from Dutch corporate law that had originally been developed to support VOC operations. When legal scholars analyzed Standard Oil's trust structure during 1906 congressional hearings, they explicitly referenced Dutch East India Company precedents as the historical foundation for American corporate law. The most revealing detail is what happened when governments tried to break up these monopolies. When the Supreme Court ordered Standard Oil dissolved in 1911, the company was split into 34 separate corporations. But Rockefeller personally owned shares in every single one. His net worth increased after the breakup because investors valued the separate companies more highly than the unified trust. This is exactly what happened when the Dutch East India Company was dissolved in 1799. VOC shareholders simply transferred their holdings to new Dutch trading companies that continued operating under different names. The apparent destruction of the monopoly actually perfected the underlying system by making it less visible to regulatory oversight. The pattern is undeniable. Both the VOC dissolution and the Standard Oil breakup strengthened rather than weakened the financial networks they were supposed to eliminate. In both cases, distributed corporate ownership made monopolistic coordination more efficient, not less effective. At the same time Rockefeller was applying Dutch horizontal integration strategies to oil, Andrew Carnegie was applying Dutch vertical integration strategies to steel production. Between 1875 and 1900, Carnegie Steel Company grew from a small Pittsburgh operation to the world's largest steel producer by systematically controlling every stage of production. Carnegie studied Dutch trading company operations through his early career with the Pennsylvania Railroad. Carnegie Steel owned iron ore mines in Minnesota, coal mines in Pennsylvania, limestone quarries in Ohio, transportation fleets on the Great Lakes, and steel mills in Pittsburgh and Chicago. By 1890, Carnegie Steel controlled every input required for steel production, exactly like the VOC had controlled every stage of Asian spice trade. The financial results were identical to VOC profitability patterns. Carnegie Steel's cost per ton dropped from $82 to $12, a reduction of 85% that made competition impossible for companies that didn't control their supply chains. Carnegie Steel's annual profits increased from $200,000 to $40 million, a growth rate that exceeded even Standard Oil's expansion. When Carnegie sold his company to J.P. Morgan in 1901 for $480 million, the transaction created United States Steel Corporation with a market capitalization of $1.4 billion. U.S. Steel immediately controlled 65% of American steel production and 78% of iron ore mining. Morgan's financing for the U.S. Steel merger came from Dutch investors who were direct descendants of VOC shareholders. The syndicate included Rotterdamsche Bank, Amsterdamsche Bank, and Nederlandsche Bank, all of which traced their capital back to Dutch East India Company profits. Dutch investors provided over $200 million for U.S. Steel's formation. Right now, in 2025, Jeff Bezos is following the exact same playbook. Amazon started as an online bookstore in 1994. Today, it controls 40% of all U.S. e-commerce and 67% of cloud computing services. But Amazon isn't just a retailer. Just like the VOC, Amazon has become a platform that other businesses depend on for survival.
Look at the structure. Amazon Web Services provides digital infrastructure for millions of companies worldwide, just like the VOC provided shipping infrastructure for European merchants. Amazon Marketplace allows third-party sellers to reach customers, just like VOC trading posts allowed local merchants to access European markets. But in both cases, the platform owner controls the rules, sets the prices, and can eliminate competitors at will. The financial engineering is identical. Amazon operated at a loss for 20 years while systematically destroying retail competitors. They could sustain losses because investors believed in long-term market dominance, exactly like VOC shareholders funded decades of military campaigns in Asia. Amazon's current market capitalization of $1.8 trillion proves the strategy worked, just like the VOC's peak valuation of $7.9 trillion proved their strategy worked. Even the regulatory response follows the same pattern. European Union antitrust investigations of Amazon mirror 1800s antitrust investigations of Standard Oil, which mirror 1700s trade disputes over VOC monopoly practices. In every case, governments struggle to regulate organizations that operate across multiple jurisdictions using corporate structures designed to minimize regulatory oversight. This isn't coincidence, this is design. The same legal frameworks, financial instruments, and organizational structures that the Dutch East India Company pioneered in 1602 are still the foundation of how multinational corporations operate today. The modern corporation is literally the institutional descendant of the VOC. Here's where the pattern gets even more revealing. In 1890, Royal Dutch Shell was founded through a merger of Dutch and British oil companies. Shell's corporate headquarters remain in the Netherlands today, and the company still uses Dutch legal structures that provide tax advantages and regulatory flexibility. Shell's current market capitalization exceeds $200 billion, making it one of the world's most valuable energy companies. But Shell isn't just an oil company. Just like the VOC, Shell operates as a global network of subsidiaries, joint ventures, and strategic partnerships that span continents. Shell's current operations include oil exploration in Nigeria, natural gas production in Qatar, renewable energy projects in Brazil, and petrochemical manufacturing in Singapore. This geographic diversification strategy is identical to the VOC's operations across Indonesia, India, Ceylon, and the Cape Colony. The financial structure is also identical. Shell raises capital through international bond markets, just like the VOC raised capital through Amsterdam Stock Exchange. Shell's shareholders include pension funds, investment banks, and sovereign wealth funds from dozens of countries, creating the same distributed ownership model that made the VOC impossible to defeat militarily. When environmental activists target Shell's operations in one country, the company simply shifts investment to operations in other jurisdictions. Royal Dutch Shell traces its corporate lineage directly back to Netherlands-based trading companies that emerged after the VOC's dissolution. The merchant families who built fortunes through VOC shareholdings became the investors who funded Shell's expansion in the late 1800s. Some of those same family names appear on Shell's current board of directors and major shareholder lists. This continuity isn't accidental. Dutch corporate law, developed specifically to support VOC operations, became the template for modern multinational corporate structures. When companies today incorporate in the Netherlands to take advantage of favorable tax treaties and legal protections, they're using institutional infrastructure that was originally designed to support the world's first global corporation. Right now in 2025, the pattern is accelerating.